What do Alex Hormozi, Sam Ovens, and William Brown all have in common? They're the first 3 people in the world that managed to exit their online info business to private equity. And if they can do it, you can do it too. In this video, I'm going to show you several exit scenarios ranging from partial exit for raising operational capital to full exit, 90% or more. Before we get into it, hello, I'd like to introduce myself. My name is Serena. I'm a business scaling strategist, and I help business owners prepare for exit or value creation. If you'd like to learn more about that, there's some links below. Now let's get on with the video. Today we're going to be reading from my new book. It's called Your Exit Strategy Blueprint, and let me tell you why I wrote it. The reason why I felt the need to write such a book is because generally private equity literature is more dedicated to investors and M&As, and I don't see as many dedicated to entrepreneurs discussing specifically how the deals are made. Well, arguably, private equity is private. I see bits and pieces like how to systematize and what value proposition is, but I haven't seen all financing options, including private debt, for business owners all in one place. Maybe there's a reason to it, and I'm being stupid, I don't know. I grew up as a finance Nepo baby, and what I do know from a very early age is that value creation is an alternative to banks for business owners who want to get access to instant capital in order to scale their operations even further. So if you're a business owner that can't seem to get past $100,000 a month, then this book is specifically for you. If you're watching this in 2026, the book is already out. Check out the links below. It's probably in there somewhere. Anyway, let's get into it. So in the book, the exit scenarios or value creation scenarios that I address are 1, partial exit, which is more than 50%, equity for raising capital, which is up to 25%, and you'll see later why, private debt, which has no dilution, and it will be treated differently than acquisition scenarios, and last but not least, total exit, 90% or more. We will have for each one a brief description of what happens in the acquisition process, different situations in which the scenario is best, a clear step-by-step on how the deal is structured, pros and cons, and investor psychology. Why would someone want to participate in the acquisition scenario in the first place? So we'll start with partial exit of a company, which is selling between 50% and 90%. So you as a business owner in this case, keep a minority equity. This means that a strategic buyer will gain control on the business, and you retain up to 49% for future upside. It's usually used when you want liquidity, but you still want the benefit of scaling, and the company itself has a high strategic value because the investor psychology behind it is that they want synergy and control, but would like founders to remain on the team for continuity. So for structure, the buyer pays cash up front for majority stake, and you as a business owner sign a performance-based earnout for 12 to 36 months. After 36 months, it's really not your fault if something goes wrong, but it's also not your reason to rejoice. And the upside of this is that it's a large liquidity event, so you get instant access to huge amounts of capital, well, proportionate to your business. But the downside is you lose operational control. But you know what? that's not really bad, because you might have been the best manager up to this point, but from now on, you won't be. You need better managers to go to the next level of this business in order for it to continue to grow and not die. There is another scenario for this, which is a private equity recap. So instead of a strategic buyer, you have a private equity firm that buys 60-70%. It injects money in the business for growth, and you take cash off the table. This is used when the business itself is solid, but it needs capital for scaling, like new markets or acquisitions of other companies or systems, a different team structure, different management. The pros for this is that you usually get a high valuation and you have 30-40% of this because the PE company optimizes the EBITDA. But the downside of this, I mean, you can see it as a downside, is that the PE firm usually restructures aggressively because they have to. It's their policy. Then there is the scenario of a secondary sale in which a large angel investor or a VC buys a majority stake. And it's used when you usually want to step back and the company is attractive enough, but not attractive. And you use it when the company is attractive, but not attractive enough for PE firms. In this case, the capital goes to selling shareholders and not into the company itself, giving liquidity without a full exit. The pros is that it keeps the company independent because it's not publicly traded and it's not part of a PE firm, the big bad PE firm. And it's a pretty simple transaction, squeaky clean. But the company is going to have a lower valuation than for a strategic sale, which is only natural. So the investor psychology behind this is that VCs will only buy majority if they see a clear exit path in 3 to 7 years, because they're not identifying with your business, they just want it for capital efficiency. Anyway, moving on. We have the scenario for equity for raising operational funds. And the first scenario is an equity dilution for working capital. So what happens is you sell 10 to 25% of equity to raise capital for salaries, for production, or for operations. So in this case, it's not necessarily such a strategic play with the capital gains, but it's going to help you have some extra cash flow for your operations. It's used when the company is stable but cash flow tight, and it needs funds to bridge financing cycles. I would guess that many business owners that we can call successful, that have zoomed past the $100,000 months, I think they would benefit most out of this scenario of equity dilution for working capital, because it kind of gives you a little bit more freedom than that month-to-month client acquisition as sole revenue source for the business. The investor receives pro rata rights and liquidation preferences because you got to promise this investment to be liquid because it's a risk. Well, they're all risky, and risk must be rewarded. We will see later on. So the pros for this deal is that, like I said, it raises cash without taking on debt, and the founder keeps clear control of the business because you're only selling 10 to 25%. That's not that much. But the cons are like ownership percentage decreases, so you have less stake in the business. You're gonna have to share the profit that you make with some other person who injected capital. At the same time, investor rights may add reporting or oversight requirements. And this is part of the custom deal that you make with the investors when they pay in to be part of your business. Usually the type of investor for this is the one that commits when they clearly see a credible founder, a believable plan, and a path to getting their money back with upside. No risk, no reward. Moving on. There is the scenario B, which is equity and convertible notes. So convertible notes turn into another 5 or 10% later at a discount. This is pretty cool. Like, it's complex, but it's cool. So it's when you sell a mix of immediate equity and also some convertible instruments to raise faster. It's used when you need capital fast. And the valuation is kind of uncertain because you haven't had like some consistent financial reporting for the past 3 years, like it's been all over the place. And you want minimal dilution now to keep control, but also you need some cash flow. The pros for this is that it really raises capital quickly without immediate dilution, and it delays the valuation until the company is stronger. So this event itself is going to raise the valuation later on when you want to go up a notch on the levels of value creation. But as a con, future conversion can cause unexpected dilution because you promised that you would give 5 or 10% later of the stakes, and that might be a little dangerous because you're going to dilute yourself beyond your control. You might lose control for the company, so careful with that. Needless to say, these convertible notes can complicate the cap table later. So the people who you're looking for to sell this are investors that like convertibles because they lock in the future upside while minimizing immediate risk. But they want confidence that the company will reach a higher valuation before conversion. And it's actually pretty cool because like their stake later on, when the convertible notes become actual stake, the company has already grown all thanks to the capital itself. That's a solid deal right there. Now let's talk a little bit about private debt. You can borrow money from private entities which are either individuals or other companies. But you got to pay attention because you're going to have different interest rates depending on the season of your business. So when you sign a deal for private debt, you have to say, I don't think this is necessarily, when you sign a deal for a private debt, you have to mention the interest rate, if there will be convertible notes, and obviously the date of maturation. So we have, for early stage, it's going to be high interest, up to 20%, because this is a high risk, it's an unproven business. And then later on, for growth stage, when you have consistent revenue, but you're not yet really profitable, you can have something called a revenue-based financing. So the repay in this case is a percentage of the monthly revenue, so it's not going to completely destroy your cash flow. But the total repayment cap is probably going to be 1.4 or twice the principal. So let's say you're borrowing $500,000. So at the end of the term, which is probably going to be $36 months maybe, you're going to give them back $100,000 in total. And you will see how you do it, because the monthly is going to depend on your revenue, but at the end, at the maturity date, you're gonna have to give the rest of the money back somehow. And I believe that online businesses that have a predictable ROAS and customer acquisition cost, and they also have solid recurring revenue, can greatly benefit, as pro rata interest rates are pretty low and they have the end of term repayment cap, for which you can refinance if you're ballsy. For the established stage of your business, in which the business is profitable and it also has assets for collateral and it has a strong cash flow, it usually has to pay between 8 and 15% interest rate, and it can be on a 12 to 36 month term. So they're secured against accounts receivable or inventory or contracts or assets. And I give this example for established law firms because they are highly profitable businesses, but the revenue is very high, but the cadence is based on deliverables. So they might have a huge payout 6 months from now when the case is over. Last but not least, for private debt is late stage, also called mezzanine debt. The interest rates are a little higher because this is a late stage of a business, and it's usually subordinated to senior debt. Private debt investors in this case want protection, priority, and predictable repayment. And now let's go to the most exciting one that the guys mentioned at the beginning of this video, Hormozy and Ovens and Brown have all done, which is the total exit of a company. I'm going to walk you through several scenarios, and I'm going to point out which one they probably did, because this is private equity, so we don't know. There's no public record of this, but we can hypothesize a little bit on the numbers because of industry standards, and that's basically it. So let's get into it. In scenario A, we have a strategic buyout in which a competitor buys you out because they want your customers or your tech. And it's the fastest path to maximum valuation. And many times you have to stay 6 to 18 months for handover. The pros, it's that it provides full liquidity for founders immediately, and it transfers the risk and responsibility to the buyer. The cons, however, I mean, if you could call it a con, because maybe this is what you want to do. The founder loses all control and future upside, and the company vision may change. I'm sure it will change under the new ownership. In this case, the investors view a strategic sale as a clear exit opportunity with high certainty of return, but may be cautious if the buyer's integration risks erode value or disrupt operations before closing. Because you can set it on fire and leave. Or it could have been a business that would have been totally dependent on you. But they do the due diligence. Like, they're not going to buy something that's dependent on you. And a deal like this is a proper deal. Anyway, scenario B is a private equity full buyout between 90% and 100%. So the private equity firm buys everything and installs their own management. It's used when founders want complete liquidity and a clean exit from the business, and also when a PE firm sees opportunity to optimize and scale the company fully for a future sale. The PE firm buys out all the existing shareholders, so you and your original investors or the business partner or the family members, whatever, and they usually finance it with a mix of equity and debt. And when I say a mix, it's more like 20% cash up front and 80% debt, using something called the leverage buyout. Management may stay under new contracts, or they may also exit completely. Depends on the deal. So the PE investors pursue full buyouts like this when they see a clear path to value creation and control, seeking predictable returns through operational improvements, financial engineering, and eventual resale. They want to be able to take your business to the bank and get money for it. It's as simple as that. And this is actually what I hypothesize that is William Brown's exit scenario. I hypothesize, again mentioning that this is private. It could be that he had sole ownership on the entire business, and it could be that after all the 6 phases of this deal, the company was valuated for $18.2 million, which is huge. And William received 90% of that, which is $16.4 million. But he also still had 10%, which could have been tied to an earn-out clause or to performance payouts tied to future EBITDA for incentive. The founder remains with 10% as rolled equity, giving them a minority stake for continuity post-sale. The rationale is that this business has steady cash flow. Like I said, it's proven. It has recurring revenue. The PE controls the operations and the scaling strategy. It might go in a totally different direction than Will wanted. And the LBO, the leveraged buyout, likely gave PE an attractive return on equity that in turn maintained or actually grew EBITDA, because they could manage a good deal with the bank as well, and the company had a lot of potential to grow, a lot of meat on the bone, like Will likes to say. It's needless to say that none of this information is financial advice. These are only simulations and hypotheticals that serve to educate you regarding your possible options for partially exiting or fully exiting the company that you own. Exits are a very difficult thing to achieve. That's why at the time of 2023, only 3 people in the world managed to exit to private equity. So curb your enthusiasm. And please check out the rest of the channel because there's more. Thank you for watching. Bye.